Darrell, let me ask you. I know, we were talking about this a long time ago when there was no volatility in the marketplace. When there's no volatility in the marketplace, what do you like to trade?
When there's no volatility in the marketplace, like when the implied volatility is low.
Yes.
The nice thing about that is there are a ton of contracts that will be available, basically, that will mirror the market, even the lower cost ones.
Okay.
So a lot of times you have to go more for the dailies.
Yeah. Okay. That's
to
right.
get the lower premium contracts.
Yeah.
But I have copper up here. Let me switch over to, let's say, oil. A little more commonly traded. So, on oil right here, I mean, we're talking about contracts that, what you're looking for is that close proximity. So I choose near the market here on my scanner.
Yes.
And so, we have contracts that expire in 40 minutes and an hour and 40 minutes and 4 hours.
You know what, Darrell, just so I don't think we have your chart in the den yet to see anything.
Oh, okay. Well, let me click one more button and I will fix that right there.
There we go.
Be showing in the den.
Okay, cool.
All right. And to get the coffee going, So, we got 40 minutes, hour, 40 minutes, and 4 hours. And I just chose near the market. So that just means, really close to where the underlying market is what the bid offer is. Okay. So the closer that bid offer is to the underlying market, the better as far as speed when choosing a contract. And so when you have low volatility, it's really easy to find those contracts. And the cool thing is, a lot of times I'm not in a trade for more than an hour myself.
Right.
And so I can go in here, and I mean, this contract right here is only 3 ticks away from the market, which means it's going to trade pretty much par on par. And I have a $40 risk for 110 tick upside on oil right now. And oil's just moving up at the moment.
Yep.
So I mean, that's a fantastic risk reward. That's better than a binary trade that you're ever going to find. And you're getting a tick for tick move.
Right.
So, and then I can go down here. I can even look at some of these, and if I want to have a whole lot of room to move, I mean, this one's a maximum $69 risk. Now that's if I held the trade like this blindly and let it go all the way against me. Okay.
Yep.
And I have 233 ticks upside, and that's for 4 hours.
That's pretty cool because you can see. So I'm just looking at everything, right? So it's trading right now at 46.63, and you can see the bid offer is 46.64 by 46.66, where it's almost essentially at market with that kind of huge risk reward. And it's like the market's kind of saying there, Darrell, right, where 67 cents of downside risk is kind of, just because there's so little volatility priced in, is kind of enough volatility to the downside that they're not going to make you really pay for that risk reward of risking 1 to make 4. But guess what? That's where if you're trading expecting more volatility than that, then and you get a rise, then that's pretty phenomenal. You can lock in at almost market where you're paying 3 ticks maybe of premium for risking 1 to make 4 if you get some serious volatility. And oil, man, if we haven't got a week like last week,
and even on the flip side, we got one over here for $47 of risk with $5 of premium, with a $452 upside to the down. I mean, so it's both directions. It's not just like they're pricing in one side or the other.
There's so much going on right now, too. We were just looking at, so you have Yates talking to Congress at 2:30. That really shouldn't probably tie into oil, but that could definitely tie into the
marketplace.
Well,
but then
and this is fantastic. I mean, we're talking, the market's moved, like right now, 45.80, 46.60. I mean, we're talking, what is that, 60 pips? 80 pips. 80 pips of movement.
Yep.
And on oil right here, I got a oil chart. I'm trying to grab it so I can bring it over, but it's taking a second.
No, because you have OPEC, I was just going to say, coming at the end of this month, May 25th, I think, is their other meeting, their next meeting. So at some point, speculation is going to start creeping into what's going to happen there in the oil market. And it probably already did last week, really, but...
And I mean, right there, check that out. I mean, oil is like, I mean, it's moved 80 ticks today. That's a $800 move. So and I mean, we got like very low volatility, so there's plenty of choices.
Yes.
And the cool thing again is you're not paying for a lot of premium. So if you go in to trade this, especially if you're trading like say this contract right here, this would be sort of these would be my picks personally. And you go in, you're trading those contracts. You got tons of upside. You got very low downside.
Yep.
And
And you already had oil reject lower price last week. They trashed oil, which is really that's what's so cool about this right now.
It's
too.
quite a move last week. I mean,
know.
just huge volatility and huge downside. Yeah.
Yeah, and then if let's say you have like this, like I really think oil's just going to crash on back down today.
Yeah.
Let's say that's your move. You think it's coming in the next couple hours. They're just waiting to set everybody up. Whatever your opinion is. I mean, or to say in the next hour, you could go in and like you could sell this contract. This is sort of a cool, probably one of my favorite. It's actually my favorite thing. It's the first thing I ever came up with Nadex, just because I was naturally a futures and options and Forex trader before I found out about Nadex. Okay, traded equity options, and the best way I can describe this, I can visually show you, is right here. Let's say you were gonna go. We'll just say short oil, okay?
Yeah.
Then you could choose, like, say, the master spread if you wanted to, okay? Or let's go with the cheaper one because that's even a better, risk reward there, right? And if you wanted to lower the risk even further, like that's a $51 risk. So, and it's only $1 a tick. So maybe you're doing 10 of them. So now that comes a $500 risk. Maybe you're not comfortable with that. Well, I can put on a hedge, okay? So right over here for $34. Now, does it cost me $34 is the question. And the real answer is no when I combine the two together, okay? Here's my risk on a hedge. So my real position is I think the market's going short.
Yeah.
Right? My risk is the difference between where I buy this one and sell this one.
46.52 and 46.
Yeah, 46.62 and 46.53 about.
Right.
So about 9 ticks. Okay, so $9. So if I put those two contracts together, and I did 10 to equal an actual full-size oil contract.
Yeah.
Okay, we're talking about a $90 risk. Okay, literally a $90 risk on oil, like a full oil future, equivalent, and it can go 112 ticks against me, which is $1,120 move against me on a full-size oil contract, so 10 contracts. So I'm taking $90 of risk to fade oil. Okay, who wouldn't have a 9-tip stock, right? And it could literally move $1,000 against me, and I'd still be okay.
That's pretty
We'll
cool.
We'll talk about it when we get back. This is my favorite thing on Hedging.
You can do a whole show on those double-sided.
Seriously.
For sure, seriously.
And we will.
Yeah.
Darrell, when we look at this trade now, right?
Okay,
So,
and I actually put the trade on just to show, how little fear I have on this trade. Okay? I mean, I just you know what? Let's go short. Okay?
Yeah.
So, and for whatever reason, whatever your chart says, whatever, okay? And one thing that you'll notice as we go back and forth on this trade is my profit and loss, like it may pop around for a second, but should never really exceed the net between my profit on my long and the profit on my short and the loss on my long in this case, or vice versa, should never exceed $90.
Right.
Okay. So right here, I'm going in and I go short. I went short the master contract, and the benefit of doing I didn't have to do the master, but actually I did.
You did the $5 one, right?
I did the $5. Yeah, the $5 one. Because the master would have required a lot more money. So I went short this one. I only had to put up $590 to do the contract.
Sure. So it's 59 cents away from the top of that box.
Which if you go trade oil, you're putting up $500 to $1,000 for an intraday if you have intraday margins at your broker. Okay, so that's right on par with what you'd be paying at like an AMP or an intraday brokerage or whatever. Okay, so we're not putting up more money than we putting up really to trade the futures anyway. To go short.
Sure.
And I went short. I mean, it's like 5 ticks off where the market is.
Sure.
All right. And then I did basically I went in and I did a married call for you option traders out there. Okay. And that just means I went in and I bought an option to protect, the opposite side in case I'm wrong.
A certain amount of the opposite side. Right.
Exactly. And it'll protect me up to 47.75, up to the ceiling of that contract.
Yes.
Okay. And you can visually see it here on the graph. That's what this graph
is. Which is $1.50. So you have a $5 shot, $1.50 long.
Yeah, exactly. So, I mean, it can go pretty far against me. And I mean, that's a big stop. I mean, I would not go in personally as a trader and go short oil and put $1.50 stop in.
No, I'm with you. Now, that contract cost you how much?
That contract cost me, I bought it, it was like $30 when I got it.
$30. Okay, cool. Okay. So I get it. So if you're right in the context, let's say that this is a great example, folks, that he's just set up here. So that would mean that you'll start making money. Let's say the trade goes with you and oil goes down. You're going to stop making money after a 30-cent move.
Right.
Because
exactly.
that's
the one thing that has to happen, and some people don't get this. The one thing that has to happen is I got to lose the max money on my option because that's my insurance premium.
That's right. Exactly. And that only cost you 30 cents, though.
Right. And then I got to sort of make that back.
Exactly. Right.
Okay. So we are talking about, it has to move about 60 cents before I'm really making, really making some money. Okay. Now, I'll actually pick up some before that because of how premium works.
Yep.
But as it keeps going down, let's say I think it's going to go back down near the low of the day. Okay?
Yes.
So right there at 40, what is that, 46.80, something like that. That's pretty close to 45.73 is the half deviation mark. So let's say it pulls back down to that level, then I have a really nice profitable trade. But as this thing oscillates for the next hour and a half, then as long as it doesn't go all the way up 100 and basically 56 against me,
yes,
okay, which is a big move, my risk on this trade is not greater than $90.
Right.
It never will be greater than $90. And I mean, see, it's flying up right now. If I was in that trade,
yeah,
I'd be freaking out a little bit right now, right?
Yeah.
So I'd be like, oh, I need to get out, whatever. I definitely have a stop already where that's at. Okay, but let's check out my risk and reward. Oh, I got another trade on, but ignore that one at the moment. But the 170, so I mean, it's basically at $90. 90, 100. Just like I said, bid offer spread moving around a little bit. Got some helicopter coming in, but but right there, look at that, making 160, losing 200. I mean, it's $40 difference. Okay, I mean that's
the thing is moving.
Oil's getting some action right now, right?
So I'm doing some other trades on the side here. But anyway, so that right there, I mean, right now, I'm down $60, $50, $30. But see, I have the hedge.
No, I'm with you. Right.
So in a sense, I'm, and this is sort of funny, but I'm bored. Right. I'm waiting for oil to move down, and anytime you enter a trade, you should always accept your risk. Right. Say this is what I'm willing to lose on the trade.
Sure.
Well, the lower I can make that, the better I feel.
Right.
Personally. Right. And I don't make bad decisions whenever my risk is lower, right? So whenever my risk is in check according to my account size, okay?
Yep.
So, I mean, right now, I'm down 50, but that number really isn't going to go above, like I said, it may go say $100 or whatever.
No, I'm with you.
Things are flying. But at the end of the day, if this thing just settles, okay, $90. And so I'm really not watching every tick. My heartbeat isn't going up and down as the market moves. When that market flew up for a second there, literally my heartbeat didn't raise at all. And that is so huge for us as traders, I mean, just to be able to have that calm, in the middle of the storm here while we're trying to ride these waves. And
now the difference, though, that we also got to make sure that people know that hedge that you have there.
Yeah.
That is only good. You had one side on for a few hours and another side just for 1 hour, wasn't it?
Exactly. So this contract can expire at this point now an hour.
Yeah.
Okay.
Okay.
So, it doesn't show the minutes until we get.
No. So you want to get out of that? I'm with you.
I have
right.
an hour and a half.
Yep.
So, I mean, if the thing hasn't moved my favor in an hour and a half, do I still want to be in the trade anyway? No.
No, you're right. No, I see it. I just want to make sure the audience knew that. Okay, it's not a full match all day long.
Sure.
Exactly. Now, I mean, right now, if I decide to get out, I'd have a $50 loss in the trade. That's nothing on oil. $50 on
it's not.
Contract where I can make $1,000 a point.
Right.
Right. So, if I can just get this message, if people that are listening will just really, really soak in what I'm saying right now, especially you future traders out there.
Yeah.
Okay. Is I can't lose more than $90 on this oil future contract, and I have a $1,500 stop loss.
Right.
For the next hour and a half.
Right.
And I can do this on every contract that's on. I mean, I can do this on the Dow, NASDAQ, S&P, gold, silver, copper, coin. I can do this on FX traders. I do this on euro dollar, pound dollar, Aussie dollar, pound. I mean, all of the contracts on Nadex, I can do this on.
Right.
So it makes it like whenever I found out about Nadex the first time, I mean, we're talking like 7 years ago, okay? And I was drilling them and like, what is this really? And, because I was all, skeptical. And when I walked away, I was floating on cloud 9. I'm like, oh my gosh, I just found a contract where I can mirror futures and I can hedge my futures trades with a daily or intraday expiration, which means that I get if you know anything about options, what's called maximum delta, which means moving at speed of market type thing. I can get minimum theta, which means I'm not paying a ton of premium.
Yeah.
We'll keep talking. This is it's so huge. If you grab this, you'll love Nadex. It's awesome.
Perfect.
A trade right now, an oil trade that's actually on both sides of it, which is a pretty cool deal here.
Okay, so what we're doing is, I have a chart up, and this honestly wouldn't have been my first choice on a short trade, but it's actually working out really well. It's what I would actually look for in a short trade. We got in a little bit earlier than I normally would have, but we got it actually up here. Okay, so I was like, hey, it's starting to tick down. Let's just take it. And, for whatever, because there's 1,000 reasons people take trades. So, and I'm trying to show how universal the strategy is.
Right.
So it doesn't matter, who you're following or what you're doing. This is something you can do if you like to trade futures or if you've wanted to trade futures and you've been nervous about, rightfully so, about the massive, risk you're taking.
Leverage, sure.
Yeah,
right.
the leverage is huge. You're controlling, 50 barrels of oil. That's a lot of oil. Actually, it's 100 barrels of oil on a full-size contract. And so you're talking, 56 grand, or I guess at the moment, $46,000, and you're putting $500 to $1,000,
right.
And oil can move $3 or $4 in a heartbeat. We've all seen it.
We saw it last week. You don't have to go too far back. What, 3 days?
Yeah,
right.
Yeah, and so what I'm doing right here is I just said let's go short oil, and we had an awesome contract where we only had to put up like $40 to do the trade. It's like $40-$50, and it was 4 ticks away from the market. So we're talking. What that means is the bid right here is 4 ticks away from where oil's actually quoting.
And that's pretty amazing, folks, because he was close to the top of the box, number one, and you were still only 4 ticks away, we started this whole conversation out that the volatility is so low in the marketplace right now.
Those risk rewards.
Yeah, every contract on here is really low,
right.
Volatility on the market. I could have got a cheaper contract too, by the way, but I wanted one that was, sort of close to the market there.
Sure.
And so there's even better options I probably could have chosen, but I wanted to show hey, let's choose this near the market because we have so many cheap near the markets. And so I went in, and the risk on the trade is going to be, just a reminder, very simple formula, the difference between where you buy one and where you sell the other.
Sure.
Okay? Because people think, well, is my risk like 59 times 10 plus, $30 times 10? No. It's ultimately, as long as I exit before this trade expires here in, an hour and a half or so, okay, then my risk is not going to be greater than the difference in those prices. So we're talking, $8 actually. So on our fills. And
Darrell, just to spell it out too, because so what happens is, so the short one cost you, let's say, $50, right? You're 50 ticks away from the top, and the long one cost about $30 per contract, correct?
Exactly.
So that $30, that's really kind of all you're giving up to have that insurance, right?
I know.
So what happens is when you actually, let's say that you do make that short trade and that the market just immediately starts cascading down and goes in your direction, if you had not had that kind of second trade on, the only difference is that you now have, 30 cents of movement where you're just kind of recouping the cost of your insurance before you enter into a profitable position. Is that correct?
That is 100% correct.
Perfect.
But the cool part is to add in, just a big thing to add in is the 30 cents is the cost of my insurance to recoup. So that's not that's 30 cents is nothing in oil.
Sure,
Okay, we've
right.
done that while we've been on the air.
Yeah,
Okay.
right.
To limit your loss to 9 cents, it's definitely nothing.
But my actual risk is 9 cents.
Right.
And my stop loss is the ceiling of the trade, since I went short and I bought as a hedge.
Right.
So we're talking 40, 70, 75. So if I go over here, let me just grab like a simple, let's see, 10. No, I have to have less.
Because when you say stop loss, though, and that's why I wanted to spell it out, you're actually making money on the tail end of that one as well.
I actually, that's one of the things I actually didn't bring up was if you look at this risk-reward section here is as much profit as there is, because there's $124 of profit in this, okay? So if it actually did fly up, then it'd have to fly up, 58 ticks above,
Right.
Where I got it. Which, I mean, again, not a big move on oil.
Right.
We've done 80 plus ticks today.
Definitely in the realm of possible, right?
Yeah.
But if it flew all the way up there and I got out my stop loss, that protects me $1,200, against, the market moving, or $1,500 against the market moving against me. My stop loss would actually end up making money.
Yeah, no, it does.
So
it makes a lot of money.
whether the market goes down or the market goes up, I will profit on this trade. And if it just stays flat in this little range,
that's where
then
$90 gets lost.
I
Right?
lose $90.
Yeah.
And that's not again on 10. It could be $9.
Right.
So if you have a little
$9
account,
per contract,
I know.
you
You could
could
trade
right?
this.
No, pretty cool, man.
$9 if you have a little account. That's your risk.
Right.
Okay. If you have a bigger account, 90 or 900. Okay. But I can make money if it flies one way or the other. I'm gonna money is gonna be in my pocket.
Yeah.
If it doesn't,
And just say, the visual parts was so cool, man. So you're going short, and your insurance, your real trade, let's say, cost you $50, as in the short one. Your insurance costs you 30. So as in, if you go negative, you need to make up your insurance. So you need to make up that 30 cents. And guess what? If it goes to the positive side, then what do you need to make up before you gain positive, profit? You need to make up the 50 cents from where it is, and then you'd actually have some profit.
Then I got 70 more ticks of profit, which is $700.
Pretty cool, man.
So we're talking $700 to the ups if it flies up that I could potentially profit. We're talking 4,400 and let's take away the 30, 4,110. Okay, to the downside if the market were just to this bottom and fly.
And
okay,
there's
for a $90 risk.
There's a lot going on. We got cell phones going everywhere. But I was gonna say with OPEC.
I thought a commercial was coming up.
with OPEC coming out the 25th, I mean, you just never know when there might be some type of announcement from an OPEC country
for sure.
ahead of that meeting.
And this is a fun trade to do on OPEC, especially if you can pull off. I mean, let's see, could we pull this off? All right, here's a question. Let's say OPEC was coming out. Look at that. We could go in there, and that's a nice, not have to move like $1. Okay, but OPEC, I mean, it can move $2 or $3, right?
And we might see the premium go up on these as we inch closer to that date, for sure.
So, but on this, let's just say it was somewhere around that right now, just so people can see. Now, we're talking $1 move requirement, really, for us to start making money, okay? But, I mean, we're still talking right now a $9 risk, okay, on the trade. And we have, if we did 10 contracts, a $2,400 upside and a $4,400 downside profit potential on the trade if the market flies in either direction. Now, again, we're locked into that $9 risk until it moves, okay? So what I like about this, the biggest thing I like about this trade is I've accepted my risk. I'm risking $90, but I don't have to take my stop at all.
Right.
I can just sit here. And now at the end of an hour and 40 minutes, I'm going to have to make a decision or put another hedge on or whatever.
Right.
Okay, so I don't increase my risk. So I may just close out and say, there's my $50 or $90. Or I may put on another contract to hedge it off. There's plenty of options of what I can do. But for the next hour and 40 minutes, I can sit here and I can eat my cereal and do nothing.
No, it was a good discussion because people can get that and then they can go play with that demo, open a demo account, start putting multiple trades on, and then you'll at least have a nice base to say what you're going to build for.
Big time.
Yeah. What was interesting, I saw even some of the news, and I think it went away, but they had the Saudi oil minister was already talking about extending OPEC cuts. So it's interesting that already across the news was coming. Just as we came back from that break, I saw it.
Oh, yeah.
Which is interesting.
Oh, they're trying to make a deal.
There's already the oil ministers out there saying, whatever they want to say. and we still have a good 2-3 weeks. But
they're trying to make a deal with Russia right now because they're freaking because it went down so dramatically. Here, oil says this Saudi Arabia, Russia say cuts may last into 2018.
Right.
They're both scrambling, man. They're going to be like the best buddies in the world.
That's it, yeah. Last week was a big week, right?
Yeah, right. You know, you go from $50 to $45. Both of those economies need that money. You know,
especially because we hung around that $50 number for so long.
We did.
It was quite a break away from it last week.
Oh yeah, listen, and the gasoline. You know, what you had there, folks, is that the gasoline broke down also. And it's like, okay, we're coming into driving season. Gasoline is getting very inexpensive. You know, and this is going to need more than that. You know, I like the rejection of price last week, but today. It's having a hard time getting into this higher price. You're probably going to be making money on that trade, Darrell.
I'm all about it.
Yeah, listen, why not?
Who isn't? Right?
Yeah, totally, man. Yeah. Totally.
I mean, it's keeps pushing down. If it breaks that level with some volume, we're going to get a nice drop.
Exactly, because what happens, folks, is that when you get two downdrafts, which we got last week on Wednesday and then on Friday, I remember I was talking about the people load up again. It's like, get stopped, and it's like, hey, that flush out, that looked like it was a large flush out. Let's put it that way, so I can picture why people went right back in.
Sure,
no doubt about it. Folks,
I mean, I'm literally sitting here relaxed, bored in a full oil contract with a $1,700 stop loss, and the most I can lose is $90. I'm just watching the market.
That way you're making smart decisions.
That's pretty
and
intense.
Not emotional.
It really is.
You can't let people. You can't. You should be making trades where you're comfortable with the risk.
With that much leverage, that you only can lose $90 is pretty incredible.
And it's 90 per 10 contracts.
Right.
A lot of people are trading single contracts, so I like $9.
And I see people talking in the room about right now the Tiger did about ES, NQ, YM, gold.
Do it all.
You can do it on
Get in
all
there.
of them.
Get in that demo account. Start playing with the multiple, and that's really where when you're doing the multiples, play with that in the demo because you'll really get comfortable before you put your money at risk.
Totally.